Hi there, welcome to this second lecture on the course of infrastructure finance. In this lecture we are going to mainly talk about what are the different sources of financing for infrastructure, and when I am going to discuss this infrastructure financing sources, I am going to broadly look at it from the perspective of what we actually see in India, but by and large I guess these trends are going to be there is going to be a lot of commonality in the trends across other countries as well. So at least the data, while I am going to use what we see in India, I think the trends is going to be by and large not very different when we look at other countries as well. But before we actually do that, let us go back to the thought questions that we discussed in our lecture 1. What was the two thought questions that we looked at? Question number 1, can you think of some public goods other than those that were discussed in the lecture? Now, did you actually have a chance to think through and come out with some of what could be called as public goods? Okay, I will give you two examples. Example number 1, radio transmission. Why could be radio transmission a public good? Because it is going to be very difficult to exclude somebody from receiving a radio transmission. Let us say, for example, in a normal FM transmission, anybody who is having a standard radio set, he will be able to receive the FM transmission. So it is going to be very difficult to actually exclude somebody from receiving the radio transmission. So that satisfies one of the criteria of public good. The second criteria is non-rivalry. Because one person is receiving the radio signal through his radio set, it is not going to affect another person receiving the same radio signals in any significant way. So there could be as many people as that can be who can listen to the radio set at the same time without significantly affecting the quality of each other's reception. So it actually satisfies conditions of both non-rivalry and non-excludability, and therefore it can be considered as a very good example of a public good. Let me also give a second example of a public good, which is national defense. Why is national defense a public good? It can be called as a public good because, again, it has characteristic of non-excludability and non-rivalry. It is very difficult to exclude somebody from being benefited from national defense. When defense is being provided for the whole country, it benefits the entire population. It is very difficult to single out somebody as to not to receive the protection of national defense. Similarly, just because somebody is being protected by national defense, it does not mean that others are being deprived of it. Everybody is benefiting from the investment in national defense. So it could be called as a good example of a public good. Any questions? Now let us look at the second thought question that we looked at, which is government is planning to set up a new airport in city A. What could be the externalities that are associated with the project? Now we talked about externalities of two kinds. The first is a positive externality and the second is a negative externality. When we briefly touched upon this example in the class, we had looked at some externalities. Now we will try and see if there are many more. First, let us start with the positive externality. Positive externalities could include the increase in land prices. Because the airport is coming up, the prices of the land surrounding the airport region can actually increase, because people might perceive that airport is going to result in a lot of economic development, and therefore people will be willing to pay a higher price for the land around the airport region. Another positive externality could be an increase in commercial activity. Because of the increase in people movement, there could be a lot more investments happening in the regions surrounding the airport. The third positive externality could be employment generation. Because of the traffic that is coming to the airport and the need to cater to the traffic that is coming to the airport, there could be substantial amount of employment generation. For example, an airport being built up results in new construction jobs, an airport in operation results in new jobs in various sectors. For example, it could be in catering, it could be in housekeeping, and so on and so forth. So there are substantial amount of positive externalities that happens in an airport project, but that is just one side of the coin. Along with the positive externalities, there could be several other negative externalities as well. What could be the negative externalities? Let me give you a few examples. The first is project affected people. For example, airport is going to come in a land area which is going to be previously inhabited by, let us say, agriculture, and when the airport comes up, the existing people will need to be displaced to pave way for constructing the airport. So there could be people who are going to be affected by a loss of livelihood because of the airport project coming up. Now that is a negative externality. The second could be increase in vehicular traffic. People might experience over a period of time a gradual increase in vehicular traffic, which can result in a lot of other effects. For example, there could be more noise pollution, there could be more air pollution, and people who are living in the region surrounding the airport, they could get affected by this increase in vehicular traffic. The third negative externality could be, let us say, for example, increase in rental levels. Because of an additional prospect of better commercial development around the airport region, the rental levels can perceptibly increase, and those who are actually staying in rented property might therefore get affected because of this increase in rental levels. So this is a negative externality. At a day-to-day level, there could be several negative externalities as well. So let me actually talk about what I heard in the case of a Bangalore airport. The new Bangalore airport is at a distance away from the city. Before the airports were being constructed, the road that was passing through the airport was very narrow, had very less traffic, and people were able to easily move across the road from one side to the other without any major problem. But after the airport has been built up, the road that connects the airport has been substantially widened, and the vehicle traffic has increased manifold, and for the safety of the vehicular traffic, there has been a median that has come in between the road. Now people who are living in that region, who were used to crossing the road from one side to the other, because of the median coming up, had to experience a lot of difficulty in crossing the road. They will have to travel some distance and wait for a break in the median where they could actually cross. So at a day-to-day level, people could experience certain amount of discomfort. So this could be a negative externality. So in sum, if you look at an infrastructure project, can result in several positive as well as negative externalities, and it is very important that we recognize those externalities. We should try our level best to minimize the negative externalities so that the project can proceed without any interruptions or problems. Okay. Now let us come back to the topic of this session, which is an overview of financing sources of infrastructure. Let me start with a short question. I am going to give you 3 choices and ask you to choose which is the odd one: electricity generation, telecommunication, and civil aviation. These are all 3 different infrastructure sectors, and if you have to choose one sector that is different from these 3, which one will that be? Okay. Have you been able to think through? My choice would be to look at electricity generation. Why electricity generation? Well, that could be several reasons, but the reason why I choose electricity generation as the odd one out is because of the governance that is actually seen in the electricity generation sector. Remember, if you really look at infrastructure, infrastructure benefits across all segments of the society. Therefore, the regime that actually governs each and every infrastructure sector is also very different. If you really look at levels of the government, they can be broadly classified into three categories. At the higher most level is what is called as the central government or the federal government. So, some sectors of infrastructure come under the purview of the central government, and next to that comes the state government. There are some sectors which come under the purview of the state government, and the third level is the local government, and there are some sectors which come under the purview of the local government. Now, I should also mention that there are some sectors which are governed by both the central and the state, and these are called as concurrent subjects. Now, if you look at the three sectors that I just put out in front of you, telecommunication and civil aviation are under the purview of the central government. In the sense, the operation, the regulation is all governed by the ministries at the central government. But if you look at electricity generation is under the purview of both the central as well as the state government. So, to that extent it is called as the concurrent subject. Electricity generation is to some extent comes under the state government and it also under the central government, and therefore, among these three that makes it slightly different. Now, let us go to the next one. Between these four choices, which one would be the odd one? National Thermal Power Corporation, National Hydropower Corporation, Gas Authority of India Limited, and Adani Power. Have you been able to think through? Okay. Out of this four different entities, remember these are all four different companies that are operating in the infrastructure sector. Now, some of you might have chosen Gas Authority of India Limited as the odd one out, which could be perfectly correct, because out of these four companies, three of them are power generating companies, whereas Gas Authority of India Limited is a gas transportation and supply company. So, to that extent you may feel that that is a different one. That is a different one if you look at the sectors at which the companies operate. But let us try and look at these companies from a slightly different perspective. Let us look at it from the ownership of these companies. So, if you look at these four choices, except Adani Power, all the other three companies are owned by the public sector. In essence, these are all government owned companies in substantial way. Adani Power is as a private sector company. So, I would actually consider that as an odd one out. Now, why am I showing this? The reason I am showing this is to highlight the fact that in the infrastructure sector we have both public sector as well as private sector companies, and in some of the sectors we have both public and private. Let us say, for example, as I had shown in the case of power, it has both private sector and public sector, but there are some sectors which are largely under the purview of the public sector, and there are some sectors which are largely under the purview of the private sector. Okay. Now, let us go back to what we wanted to start, to look at the different sources of infrastructure financing. I am actually going to show you the investment in infrastructure in the 3 5-year plans that we have in India. As I was saying in the beginning, I am going to actually base this lecture on data from India, and in India a substantial amount of planning is done in terms of the 5-year plans. Infrastructure being very long term projects, they actually play a very major role in the 5-year plans. So, the 5-year plans identifies the quantum of investment that is expected or need to be made in the infrastructure sector to support the economic growth of the country. So, as we are speaking today, we are completing the 11th 5-year plan, which is starting from 2007 to 2012, and the government has actually made preparations to finalize the targets for the 12th 5-year plan, which starts from 2012 and ends in 2017. Preceding the 11th 5-year plan, we actually had the 10th 5-year plan, which started at 2002 and ended at 2007. So, we will try and compare the infrastructure investments in each of these 3 5-year plans and see how does it look like. I am actually going to show you 2 numbers here. The first number indicates the amount to be invested in infrastructure as on 2006-2007 prices in rupees lakh crores. Okay. So, what we see is in 10th 5-year plan 9.16 lakh crores has been invested in infrastructure, but in the 11th 5-year plan this has substantially increased to 19.45, and in the 12th 5-year plan this is expected to increase to 41 lakh crores. If you actually consider the amount invested in terms of market prices, naturally the amounts are a little bit higher. In the 10th 5-year plan it is 9.16, in the 11th 5-year plan it is 27.75, and in the 12th 5-year plan it is expected to touch about 51.46. Now, what can you infer from these numbers? The first thing that it should strike you is the magnitude of the financing that is involved. We are talking about an investment of 19.45 lakh crores of rupees in the 5-year period ending 2012. So, these are very very large sums of money that we are actually investing in infrastructure. So, point number 1, the quantum of investments that happen in infrastructure are very very large. Point number 2, we see a gradual, or not even gradual, I would say a remarkable increase in the level of investment that is being made in infrastructure across these 3 5-year plans. From the 10th to the 11th 5-year plan the investment has increased more than twice, and from the 11th to the 12th 5-year plan again, if you look at in terms of real prices, the expectation is that the investment will increase more than twice. So, we are seeing a very rapid growth in infrastructure investment in recent years. I will give you some other information. Let us talk about the total investment in infrastructure as a percentage of GDP. So, in the 10th 5-year plan it was 5%, in the 11th 5-year plan it was 7.22%, and in the 12th 5-year plan it is 9.14%. So, what we have actually seen is between the 10th and the 12th 5-year plan the total investment as a percentage of GDP has almost doubled from 5% to close to 10%. So, not only has the proportion increased because of the fact that GDP is also increasing, the actual sums that are being invested in infrastructure is also considerably increasing. We can also see some trends in the investment. So, the total investment that we talked about 19 lakh crores in the 11th 5-year plan is from all the sources put together, that is from the private sector as well as the public sector. So, this is the total amount of infrastructure investment in the country that is being made during the 5-year period. Let us look at how the pattern of financing has changed over a period of time between public sector and private sector sources of financing. The private sector contribution, which was about 22% in the 10th 5-year plan, is increased by more than 50% to 38% in the 11th 5-year plan, and in the 12th 5-year plan it is expected to increase to close to half of the total investment in infrastructure, that is 47% is the expected contribution by the private sector during the 12th 5-year plan in infrastructure investment. So, the trend is very clear. There is a very rapid shift in the infrastructure sector from a public sector dominated to a private sector active play. Next, let's look at what we see in the pattern between the public sector investment. The public sector investment can be further divided into two levels. One is the central and the other is the state. If you look at the state, in the 10th 5-year plan it was 32%, it is gradually reduced by 5 percentage points in every consecutive 5-year plan, that is from 32 the state share to infrastructure investments reduced to 27%, which further reduced to 22% in the 12th 5-year plan. Center similarly has been reducing from 46% to 35% in the 11th 5-year plan, and it is expected to be around 31% at the end of 12th 5-year plan. So, what can we infer? Two main points. India has realized that infrastructure investment is critical to sustain and increase economic growth. So, therefore, the total capital that gets invested in infrastructure has been consistently increasing in the last 2 5-year plans, and is expected to increase in the forthcoming 5-year plan. Point number 2, much of the investment in the future is expected to come from the private sector. Though a large quantum is still going to be coming from the public sector, the share of the private sector is going to be much higher as compared to what we have seen in the past. So, as we go down to more intricate aspects of infrastructure financing, we have to bear these trends in mind. Now, there are several sectors that we looked at in our first lecture that would qualify to be called as infrastructure. Are there any of the sectors that dominate over the other? Which of the sectors that attract the most investment? Let us look at that. I have put down here the top 3 sectors in terms of the total investment. The topmost sector is electricity, which in the 12th 5-year plan is expected to get an investment of about 15 lakh crores. So, out of all the infrastructure sector, electricity is expected to get the maximum amount of investment. I think this is kind of reflecting the power shortage that we are seeing in the country today. There has been many hours of power shortage, and this additional investment in electricity generation can be expected to reduce the levels of power shortage that we experience in the country today. The next highest sector that are going to attract the maximum investment in roads and bridges. So, this sector is expected to get an investment of about 9.2 lakh crores in the 12th 5-year plan. and the third sector that is expected to get is telecommunications, and this sector is expected to get an investment of 8.84 lakh crores in the 12th 5-year plan. So put together these three sectors account for about 64% of the total investment in infrastructure. So substantial amount of investments that we are going to see in infrastructure is going to be channelized to these three sectors. So the prospects are very large, the need is large, and for people who are looking for careers in infrastructure financing, this should also give you an indication as to where do the most interesting opportunities lie. Let us also look at whether there are any differences in the proportion of investment that is being made from different sources. Let us look at the proportion of public sector investment and the top three sectors that accounts for the highest proportion. First, railways. 82% of the railways proposed investment in the 12th 5-year plan is expected to come from the public sector, particularly the central government, which is expected because railways is still not thrown open for private sector investment in a major way, and railways is largely governed by the ministry of the central government. So much of the investment in railways have to really come from the public sector at the center, and that is why we are seeing a very high level of public sector investment in railways. Next is your oil and gas pipelines. Close to 50% of the investment in this sector is expected to come from the central government. Again, these are considered to be strategically important for the country. Oil and gas pipelines cut across different states, and therefore to manage the complexity of such interstate projects, it would be better for the central government to handle this, and that is the reason why we are seeing substantial investments in this sector also from the central government. Then we talk about roads and bridges. This is the third sector that gets the highest proportion of public sector investment from the central government. So 39% of the investment that is expected in roads and bridges are expected to come from the central government. Again, if you see, most of the road projects, particularly the national highway projects, they cut across state boundaries, and roads needs to be connected across the nook and corner of the country. Roads are expected to bring in a lot of economic development, so many roads needs to be constructed in areas that may not be commercially viable. It may have to be constructed in areas that have a very difficult and rough terrain. These are areas where the private sector might find it very difficult to get financial returns, and therefore the government will have to make substantial amount of investments. Next, let us look at the top three sectors in terms of the state government contribution. So the first is irrigation. So irrigation is mostly seen as a subject that benefiting the local populace and with very clear boundaries, and irrigation occupies a top slot in terms of the investment by these various state governments. Next is water supply and sanitation. Close to 60% of the total investment in this sector are expected to be made by the state government, and roads and bridges, which is the common sector that we see in the investments made by the central government as well. So despite the commonality that we see in the road sector, we see a lot of differences between what is priority for the state government and what is priority for the central government level. Now let us look at the third, which is the top 3 sectors in terms of proportion of contribution by the private sector. Non-conventional energy occupies the top slot as far as the private sector investment is concerned. Out of the total investment to be made in non-conventional energy, 89% is expected to come from the private sector. In telecommunication, 87% of the investment is expected to come from the private sector. Ports, 86% are expected to come from the private sector. So wherever there is an element of technology, wherever there is an opportunity to introduce competition, wherever there are commercial viability, we have a strong private sector participation. So the point I would like you to take away in this is there are differences within infrastructure sector, and the priority for each of the different sources of financing happens to be very different. Let us look at how are the sources between the center, state and private. If you look at the central government, the sources can be broadly classified into 3 categories. One is the budget allocation. The government gets its own source of revenues, and out of the revenues that it gets, it allocates certain amount of it for investment in infrastructure sector. So that is your budgetary allocation. Then we have internal generation or equity. There are several existing companies which continue to make profits, and the internal generation refers to this amount which gets reinvested back in the infrastructure sector. And third is the borrowings that the government undertakes to finance several infrastructure projects. So if you really look at it, at the central level, 52% of the funding is obtained by borrowings. The state level, it's obtained, borrowings account for 24% at the state level. But if you look at the private level, out of the total investment that happens from the private sector, 70% is by way of borrowings. Now borrowing is also known as debt finance. So what we generally see is debt financing plays a very important role in funding infrastructure projects. So this is an analysis of the sources of funds during the first 3 years of the 11th 5-year plan. So the pie chart indicates what has been the contribution of the various sources. First let us look at the various sources. This include commercial banks, which include banks like State Bank of India, Canara Bank, or any of the other banks that is functioning in the country today. And next we have NBFCs. So these are also called as infrastructure financing companies. NBFCs mean non-banking financial corporations. They are actually financial corporations, but they do not have a banking operation attached to them. So examples of these NBFCs in the infrastructure sector include Power Finance Corporation, Rural Electrification Corporation, IDFC, and there are other state level financing corporation in infrastructure sector as well. Then 4% of the amount has actually come from insurance companies. Remember, insurance companies obtain a lot of money by way of premium collections, and the amount obtained through this premium collections has to be invested, and part of that is actually invested in infrastructure sector. Then we have external commercial borrowings, which accounts for 6%. So this indicates the amount that we have actually borrowed from sources outside the country. For example, if we actually borrow from a US bank for implementing an infrastructure project in India, that is called as an external commercial borrowing. So sources obtained from outside the country are essentially external commercial borrowings. Then we have equity or foreign direct investment, which accounts for 14%. The 6% accounts only for debt funding. If the same is by way of equity funding, in essence if it is a foreign direct investment, it will be clubbed under equity. So the total equity investment in infrastructure projects has been 14%, and the biggest chunk of all has been the budgetary outlay of 45%. So if we actually remove the budgetary outlay of 45%, what we actually see is, we see a large portion of the funding is coming from terms of debt funds, that is 21% in commercial banks, 10% from NBFCs, 4% from external commercial borrowings, and 6% from your 4% from insurance companies and 6% from external commercial borrowings. So in essence about 41% of the total funding that is coming to infrastructure is by way of borrowings. Now if you look at equity, equity is only 14%. So approximately the ratio between equity and borrowings is in the ratio of 1:3. Okay. So this highlights the previous discussion that we had, that debt actually plays a very important role in funding infrastructure projects. Now I am actually going to show you some numbers from various debt sources. First let us look at commercial bank lending to infrastructure projects. So if you actually look at the credit to infrastructure, it has gradually increased over a period of time. For example, in March 2007 it was 1.44 lakh crores, it has increased to 5.4 lakh crores in March 2011. Okay. So as a percentage of infrastructure, as a percentage of overall bank credit, it has increased from 6.07% to 11%. Okay. Now let us look at infrastructure NBFCs. So these are institutions such as the Power Finance Corporation, Rural Electrification Corporation that I talked about. Even in this case what we see is the allocation to infrastructure projects has gradually increased over a period of time, starting from 1.1 lakh crore in 2008, it is increased to 1.81 lakh crores in 2010. Insurance companies. Insurance companies can be classified in two categories: life insurance companies and non-life insurance companies. In the case of life insurance firms, the infrastructure investments is actually reduced over a period of time, but on the other hand if you look at non-life insurance companies, the infrastructure investments as a share of their overall assets under management has increased from March 2007 to March 2010. You look at external commercial borrowings, the numbers here are in terms of $1 million. The external commercial borrowings actually shows a fluctuating trend because the investment from foreign sources into the country depends on so many factors. It depends on the economic conditions of the country that is actually making the investment, as well as the economic conditions of the country that is receiving the investment. So in 2007 the ECB inflow was $25,353 million, but this actually reduced to $18,363 million in 2009. There was an increase from 2009 to 2010, but it did not really touch the highest level that was experienced in 2008. So external commercial borrowings is showing a lot of fluctuation. There has not been a uniform increase that we have seen like in the case of commercial bank credit. Okay, now let us come back to the thought questions for this session. Question number 1: what should be the role of government finance in infrastructure development when private finance is available? Today we have substantial amount of private finance, then what should be the role of public sector finance under these circumstances? Thought number 2: why are state infrastructure projects more dependent on budget support as compared to central sector projects? we have seen a slide where in the case of state projects a large proportion is coming by way of budget support. Why could this be the reason? While you are thinking on these questions, I actually want to show an interesting video which captures the thoughts of a practitioner in terms of what is the essence of infrastructure financing, how are governments able to mobilize large amounts of capital to fund big infrastructure programs. You see this video and you will actually get an idea in terms of how government sources the financing for several projects. Before we end, I will give you some suggestions for additional reading should you be interested. The first reading is a report prepared by the working subgroup on infrastructure on the infrastructure funding requirements for the 12th 5-year plan. The second is an interesting report prepared by the high level committee on financing infrastructure, which has been constituted by the Planning Commission, and the interim report produced by this commission in August 2012. Okay, let us meet again in the next lecture.